for the purposes of this discussion, I just wanted you to be aware that there is a kind of a fourth possibility for you in terms of funding bucket number 3. Now, circling back to the Roth eligibility standard. So just so you're aware, households that make above $200,000, so this is a married couple filing jointly, if you make over $200,000 a year, rough 2021 numbers, you wouldn't be eligible to fund a Roth. And even if you are eligible to fund a Roth, so as a couple you make less than $200,000 a year, keep in mind there is a cap, right? And it varies based on your age, but it's $5,000, $6,000 that you're able to put into a Roth each year. And so filling bucket number 3, when you're limited on how much money you can earn and limited to how much money you can put into the Roth itself, obviously makes that a little difficult to really fill bucket 3. So a few other financial planning considerations that I want you to have in the back of your mind is pay off high interest credit card debt first. That should be number 1 priority, is getting rid of that high debt. Second one is don't count on your living expenses being lower during retirement. This is kind of a pitfall that we see people run into all the time, is they think, hey, I'm going to retire, my expenses are going to be lower. In reality, healthcare expenses go up. You're not working, so you travel more, you go out and have fun, you have more hobbies. And so living expenses, our plan is to keep them where they are today, keep them flat. The next one is that when you're self-employed, there's a little more flexibility for saving for retirement. You have access to some other vehicles, you can take your income in some different ways. So that's something that there may be more vehicles available to you if you're not, a typical W-2 employee. And obviously, if you're self-employed and you want to reach out to our team, we'd be happy to, walk you through some of the different options that exist. So you can try to follow this plan on your own. We really recommend that you consult with a CPA and a financial planner to help you bring this plan together and follow through, most critically, the funding of bucket number 3, which is how you really, in my opinion, get to a larger income that's tax-free. And obviously, if you're able to, make enough money or live on enough money that, your standard deduction meeting your RMDs plus Social Security, if those 2 income sources are enough to cover your living expenses during retirement because you've been prudent with your money, you've paid down your debt. For some people, funding in that category, funding bucket 3 may not be as critical, but for people that have, expectation of a little bit higher standard of living, that need more income during retirement, bucket number 3 becomes more and more important the higher that your income goes up. And if you're in that scenario, or even if you're in the first scenario and you want some guidance, our firm would be, happy to assist you. And, really one of the differentiators, I touched on this in the start, but one of the big things that makes our firm different is that you have a CPA and a financial planner that work together to help you with, getting this plan in place, getting to tax-free retirement. And most of the clients that we meet with, or, people that have worked with other planners or other CPAs, they're 2 separate parties. So they go see their CPA once a year and they file their taxes, and then they go see their financial planner quarterly or annually to discuss their financial plan and their investments. But, one of the questions that I ask to my clients, and I'm asking to you right now, is when is the last time your CPA and your financial planner sat in the same room? And the vast majority of people that ask that question, the response is never. They've never met. And the challenge, and really the premise of our entire firm, is how can you sufficiently plan for retirement, which for a large portion of it really depends on tax, if your financial planner never gets to know your tax situation from your CPA? And how does your CPA plan do sufficient tax planning for you in the future if they don't know what your assets are? They don't know your investment accounts. They don't know how much money you're going to need in retirement. And so our firm is built on the premise that your CPA and your financial planner need to sit in a room with you and go through all these different complexities of planning your financial future and optimize things together. And the longer you wait, if you try to plan for a tax-free retirement when you're 64 and you're retiring at 65, you're not going to make it anymore. I mean, it's going to be very hard to fill bucket number 3 adequately if you're a year before retirement. So the earlier that you can plan, the better. And our firm is just built on the premise of optimizing, of working together, to having all the financial guidance that you need under one roof. And obviously we'd be happy to, to put our resources to use to help you. And one other thing, just so you know, by attending this class, you're getting a free financial plan. So if you want to reach out to our firm, we'll do the tax and financial plan for you, which is kind of our way of getting to know you and getting to know your circumstance. And we give you some, we give you some free advice, but our feeling is that in the future, by giving that free advice, at some point in the future, you may want to use this for tax filing or managing your investments. And so we kind of make an investment in getting to know you and getting to know our clients before we start to get into a scenario where you actually formally engage us as your CPA or financial planner. So at the end, if you want to reach out and schedule to do that free financial plan, we'd be happy to meet with you and give you some free guidance. And we can kind of, we use that as a get to know you phase to make sure you're a good fit for our firm and we're a good fit for you. And so we would very much like to see you and kind of go through and present what we could do to help. In terms of investing considerations, so I understand the presentation was about, being tax-free in retirement, but I also wanted to just give some kind of investing basics for the people that, may not want to reach out and contact us to get help with their investment allocation. This is just kind of some tips that I feel are helpful to, to help put you on the right track. So the first one is don't follow the herd. I see a lot of people that, what they do is they rush out and they buy the latest trend. Some things that jump out to mind to me right now are things like Tesla and Bitcoin. I don't want to say that they're fads, but they're certainly investments that are built around momentum and, a lot of people buying all at the same time. And good investing, if you go back, good investing is buying when things are low and selling when things are high. And the way that you accomplish that a lot of times is you buy the things that everyone else is selling, and then you sell the things that everyone else is buying, right? Those are the ways that you can kind of optimize your investment returns. And you can't do that if you're following the herd. The next thing is invest based on your objectives and your tolerance for risk. So this is why when we meet with a client, we typically do a free financial plan. If somebody wants us to manage their investments, we always try to start with a financial plan, because I can understand through that process how much risk is appropriate for you. I'll use an example. If you're fully funded for retirement, we do our financial plan, we put it into the software program, and we see that you have a 100% chance of making it. You don't need any additional income. Why go out and invest extremely aggressive and subject yourself to the potential for a market downturn or something happening? Be more conservative in that scenario. And on the flip side, if we have somebody that's young, that, is starting off, but maybe can't save a lot of money, then we need to be a little more aggressive with our investments, because they have the time to recover if there were a market downturn, and they need the growth. They need investment income to get to their target goal. So the next one is don't let emotion drive your investment decisions. And this is something that I see constantly from people that self-manage their investments. Is they will, I'll use a client example. I had a client that in 2008, right near the bottom of the market, they sold everything. They got out of their investments because they were scared the market would continue to fall. And it took them 4 or 5 years to get the confidence to buy back into the market. So when you think about this client, the market bottomed, they sold everything because they were scared. Then they were so fearful that they didn't buy back in, even as the market started to recover after 2008 and stock prices came back. They were too scared to get in until the market had recovered. And then when the market was almost back, it was high again, that's when they started to buy back in. And so fear caused them to, to buy in or to sell when things were low. And greed eventually can kick in when things are too high, and you have people that are buying investments that are already, they've already missed the significant run up. And so our feeling is that you should try to separate out emotion from your investment decision. And, regardless of my education or the places that, I've studied and my experience in investment markets, the number one advantage that I always feel that I hold over a do-it-yourself investor is the fact that I try to separate out emotion. It's not my, my money. I'm trading someone else's money, and obviously I want to take good care of it and protect it as if it were my own. And obviously, as a fiduciary, I'm committed to doing what's in my client's best interest, but I also am not too emotionally attached, right? And that's something, even with my own investments, I see it sometimes in, making suboptimal decisions, that I allow my own emotion to drive what I'm doing. And so that's something that you definitely want to avoid. So in terms of selecting another financial advisor, so if you don't decide to go with our firm, one of the things that we always recommend is you look for a financial advisor who actually actively manages your investments, not buy and hold, right? So we see this all the time. Clients will tell me, my financial advisor puts me in investments. He changes it once a year when we meet, right? Well, all that he's doing is picking some investments and just letting that money ride. There's no true active management. There's no tactical adjustment to what they're doing. And, my feeling is that if you're going to just buy and hold investment classes, if you really look at the data, the best way to do that would just be to buy some low cost index funds. Very low cost of investing. It's a buy and hold strategy, yes. So you're going to ride the ups and downs of the market. But most of the time that strategy is just as effective as the buy and hold advisor who puts you into a pool of mutual funds or other stocks and just lets it go and never really makes any update based on economic or market conditions. So, my advice, look for an advisor who is going to be active, who's going to actually make trades. And then of course it's critical that you pick one who doesn't charge a commission, right? Because, for our firm, we don't charge a commission and we actively manage. So every time I make a change to your investment allocation, if I'm not receiving a commission for doing it, the only reason I would make that adjustment is if I felt that it was in your best interest, right? And going into best interest, make sure, I believe there's a 60 Minutes that discussed this in depth if you want to look that up or find it on YouTube, but there's a big difference between a fiduciary advisor and a suitability advisor. So a fiduciary advisor, which is what our firm is, means that we're committed to your best interest. When we manage your investments, we have to do what's right for you. The vast majority of advisors in our industry, financial advisors, financial planners, are something called suitability advisors. What suitability means is as long as you are a stock investor, as long as it is suitable for you to buy a stock, they can sell you a stock that is not in your best interest. It's not the stock that's most likely to appreciate in value or least likely to fall in value. All that it is you wanted a stock and they sold you a stock. They made no guarantee that they were doing what's in your best interest or picking you the best one. And if your advisor will not put in writing that he has your best interest at heart, he will not put in writing that he's a fiduciary, you should be looking elsewhere for an advisor that actually will look out for your interest. So thank you so much for taking the time to go through this presentation. I understand it was a lot of information on tax, on financial planning, on investment management, and I hope that at least gave you an introduction to the concept of getting to a tax-free retirement. Our team is available. We'd love to work with you and answer any questions that you have. And like I discussed, we do a free financial plan for you. So if you really want to sit down and kind of get our perspective on how we would plan your future, we'd be happy to meet with you and really go through that in a little bit more detail. In terms of contacting our firm, this is our information. So you're welcome to call us. You can text us. Email address is included with any questions. You can come visit our office in McKinney. And there will also be a pop-up that's going to come up that will allow you to schedule or reach out to our team if you like to do it that way. But feel free to contact us just through whichever means is most convenient for you. We would love to answer any questions that you may have about this presentation or schedule a meeting, to go one-on-one and really discuss more in depth about your particular situation. So thank you again for taking the time to visit with us, and I hope to have the opportunity to meet with you soon. Thank you.